David Walker is the president of the Peter G. Peterson Foundation, and prior to joining that, pause for just a second. Prior to joining the Peter G. Peterson Foundation, Dave, of course, was the Comptroller General of the United States and the head of the U.S. Government Accountability Office. He's also a member of the Peterson-Pew Commission on Budget Reform and the Committee for a Responsible Federal Budget. And he has recently written a book that I hope you'll talk a little bit about, Dave. He's really one of the leading spokespeople in the country who has been putting this issue on the map. He has not only talks about it from the platform of his positions, he goes around the country and speaks to this in all sorts of different forums. So he talks with the leading experts and he talks with people on the ground. So he has a great sense of the issue. He's done an incredible amount to push this on the national agenda, and so we thank him for that. And Dave, I'm going to ask you to come up to the podium. Oh, thank you.
Thank you, Maya. It's a pleasure to be here. Thank all of you for coming this morning. As Maya mentioned, Pete Peterson, my boss, and I are both privileged to be members of the board of the Committee for a Responsible Federal Budget, as well as having been members of the Peterson-Pew Commission. And our foundation, the Peter G. Peterson Foundation, was pleased to partner with the Pew Charitable Trust to fund this commission. I'm a practicing Roman Catholic. And so the answer to the question is, do we need a fiscal goal, is the same as the answer to the following question. Is the Pope Catholic? The answer is yes. We don't just need a fiscal goal. Frankly, we need a strategic plan. This country has been in existence since 1789, and it's never had a strategic planning framework that is future-focused and results-oriented. And thirdly, we need key national outcome-based indicators, economic, safety, security, social, environmental, to help understand how are we doing on an outcome basis. Are we getting better or worse? And very, very importantly, how do we compare to our peer group? Because when we look at our peer group comparisons in public finance, in health outcomes, in education outcomes, in investments and outcomes on critical infrastructure, we are below average. A great nation does not stay great by being a debtor nation and by being below average on a number of the key leading indicators that help determine whether or not the future is going to be better than the past. In my view, we are at a critical crossroads in the history of the United States. And the decisions that are made or that fail to be made within less than 5 years will largely determine whether the future for this country and our families will be better than the past. The ones that are made and the ones that fail to be made within the next 5 years will determine our history in large part. The problem is not solely spending. That is definitely true. But the problem is primarily spending in many regards. George W. Bush was the biggest spending president since Lyndon Baines Johnson. He also expanded entitlement benefits, first one to do so in a major way since Lyndon Baines Johnson. And President Obama has obviously significantly increased discretionary spending based upon the 2 appropriations bills that he signed. And there's a great debate about the size and role of government. But returning to spending, there are some very simple principles. Habitually spending more money than you make is irresponsible. Irresponsibly spending somebody else's money is unethical, and if you're a fiduciary breach. And thirdly, irresponsibly spending somebody else's money when the persons whose money you're spending are too young to vote and not born yet is immoral. And all 3 of these things are going on right now. We need to recognize that not all deficits are equal. It depends upon their size, their nature, and whether or not they're likely to be recurring in nature. For example, in fairness to President Obama, he inherited a $1.2 trillion deficit due to a recession, 2 undeclared and unfinanced wars, and a variety of other actions. And it's understandable to have large deficits when you have a recession and a number of non-business cycle challenges dealing with housing and financial services that require some action. That's not what threatens our ship of state. What threatens the ship of state are the large, known, and growing structural deficits that will be with us once the economy returns to growth, once unemployment levels are down, and once the undeclared wars are over. When those three things happen, we face large, known, and growing structural deficits that threaten our collective future, and we need to do something about them. And it's not just the issue of the deficits, it's the composition of the budget. When you look at the nature of the budget, it's changed in profound ways. Today, less than 40% of the federal budget is discretionary, meaning that the Congress gets to decide how to spend the money each year. And if you look at the Constitution of the United States, you'll find that every express and enumerated responsibility and vision by the Founding Fathers for the federal government is in discretionary spending. And that's what's getting squeezed. And don't get me wrong, there's plenty of waste in defense, and there's plenty of waste in homeland security. But the fact is, what the founders envisioned is becoming a smaller and smaller part of the federal government. And something needs to be done about that. We have to recognize that within 12 years, without an increase in interest rates, that the single largest line item in the federal budget is expected to be interest on the federal debt. And let me repeat, without an increase in interest rates, which is totally unrealistic. And what do we get for interest on the federal debt? Nothing, nada, niet, shinola, as we say in the South. Absolutely nothing. And that's the path that we're on. So it's not just deficits, it's debt. And you know, quite frankly, we've been engaging in a number of creative accounting and self-dealing practices for a long time. They finally caught up to Greece, although Greece has got somebody to bail them out. We don't. If you look at our creative accounting practices, we've had creative accounting with the trust funds for a long time. You know, in Washington, they use words that don't mean the same thing as Webster's dictionary, like trust funds. You can't trust them. They're not funded. Like cuts. It means reduce the rate of increase rather than an absolute reduction. Or like requirements for the military, which is a wish list where you're not even supposed to consider the affordability and sustainability. No wonder the American people have such low confidence. And no wonder that our representatives have so little credibility with the American people. We need to speak plain English and talk straight to the American people. So if we look at our situation, we see that if we actually were accounting for the trust funds properly, our deficits have been larger than advertised. Our debt is larger than advertised. We owe Social Security and Medicare trillions of dollars in debt. And guess what? We will honor that. We will not default on that. But we don't want to call that a liability. And so therefore, our debt to GDP ratios that are typically talked about in the press only represent public debt rather than total debt. If you look at total debt, we're over 85% of GDP. We'll be over 95% of GDP by the end of this year and heading up. We will not default on that trust fund debt. So we need to recognize that we have to be more truthful with regard to how we account for things. And the real challenge, frankly, is the fact that it's our off-balance sheet obligations. $38 trillion for Medicare alone. $7 trillion for Social Security, 7 to 8. Manageable. Actually, it's not that difficult to solve that problem. And by the way, these numbers don't count the Federal Reserve, they don't count the government-sponsored entities, because those are the latest creative accounting and self-dealing practices. We own, the American people, a significant majority of the government-sponsored entities, and yet they're not being consolidated into the financial statements of the U.S. The Fed is engaging in a number of different types of practices because the Congress and the President either couldn't or wouldn't, and as a result, its balance sheet is doubled to tripled, and it's also buying a tremendous amount of U.S. debt, which serves to hold down interest rates in the short term. You can have a short-term impact on interest rates. You cannot change market forces indefinitely. And so the fact of the matter is, new and larger, frankly, self-dealing practices and creative accounting practices have come to us have come to the fore within the last year or so, and they are extremely troubling. Dependency. The United States has become increasingly and imprudently dependent on foreign lenders to finance our deficits and debt. We are fortunate that China, Japan, and all exporting nations have been willing to lend us significant sums of money at low interest rates, but it is imprudent to continue to rely upon that. It is not in our economic, foreign policy, national security, or domestic tranquility interest. You must pay attention to your foreign lenders. They have already spoken. The reason that all of us and all taxpayers in America guarantee $5 trillion in Fannie Mae and Freddie Mac debt is because Japan and China demanded it. And while interest rates haven't gone up yet, I look forward to hearing the next panel, the actions of our foreign lenders speak loudly. They are reducing their appetite for our debt. They are buying shorter-term maturities. The duration of their obligations are going down. They're looking for commodities. They're looking for other alternative investments. They're looking for inflation index instruments such as TIPS because the factors say that inflation will go up over time, and that will compound our problems. We must recognize that there are four key parallels between the factors that caused the mortgage-related subprime crisis and the federal government's own deteriorating finances. A disconnect between who benefited from prevailing policies and practices and who paid the price and bore the burden when the bubble burst. A lack of transparency as to the nature, extent, and magnitude of the real risk. Too much debt, not enough focus on cash flow, and over-reliance on credit ratings. And a failure of both corporate and government oversight, risk management, and regulatory functions to act until there was a crisis at the doorstep. There are two big differences. First, the size, the scope, and the potential adverse consequences of a meltdown in the federal government's finances, and a meltdown would be simply a loss of confidence in our ability to put our federal financial house in order. And second, nobody's going to bail out America. We have to make tough choices. And we need to begin that process very soon and before we pass a tipping point. The good news is the American people get it. I've been to 46 states in the last 4 years doing town hall meetings, business, community leaders, editorial boards, local media. 80% of Americans believe that escalating deficits and debt and increased reliance on foreign lenders should be a top priority, exceeded only by the economy and jobs, way ahead of health care, way ahead of climate change, way ahead of other important issues. Secondly, 2/3 believe that Washington is not paying enough attention, and 70% support a fiscal commission where everything is on the table to try to help deal with the problem. There is no question it will take an extraordinary process because our regular order process in Washington is broken. And the decision by Senator Baily not to run for re-election is a troubling indicator of just how broken it is, as well as decisions by other senators, such as Senator Voinovich, Senator Gregg, etc. These people are promoting fiscal responsibility. These people are focusing on the future, and they are disgusted not just with partisanship, but the ideological divide and the stalemate that we face. It's one thing to have a stalemate in Washington when things are going well, because after all, government can, and listen to me carefully, muck things up. That started with an M. But when things aren't going well, and when they're deteriorating with the passage of time, having a stalemate is a disaster. And that's where we are right now. So I want to commend President Obama for recognizing the problem. His steps with regard to the fiscal 2011 budget were modest. They were modest with regard to the short term. They did not have the type of really goals that we really need to see. But I do want to commend him for recognizing that we need a fiscal commission. It's sad, but we had 7 profiles in caving in Congress when 7 sponsors of the Conrad Gregg bill didn't vote for it when it came up for a vote in conjunction with raising the debt ceiling limit. So, John F. Kennedy's book, Profiles in Courage, would even be thinner today than it was back then. But the simple fact is having a presidential commission is better than having none. But there are key factors. The scope. Everything has to be on the table. Secondly, the role. It must educate and engage American citizens beyond the Beltway on the truth, the tough choices, the prudence of acting sooner rather than later, and the potential consequences for our country and our families if we do not. Thirdly, it must set goals. And the goals of just 2015, deficit to GDP, in my opinion, is not enough. We also need a debt to GDP ratio for the longer term, which is what the Commission recommended. And I think we also need to make meaningful progress on reducing the tens of trillions of dollars of unfunded off-balance sheet obligations. So a triple goal for any type of fiscal commission. For membership, they need to have capable, credible, and committed people who are not only capable and credible in Washington, but in the real world outside of Washington's Beltway. Because right now, that's a real problem. And thirdly, with regard to committed, they have to be committed to come up with nonpartisan solutions that can achieve bipartisan support, and they have to be willing to spend the amount of time that will be necessary to accomplish all these objectives. Obviously, the end result, recommendations that should be acted on by the Congress. Timing. This year is the year to engage the American people with the facts, the truth, and the tough choices, and as well as other interest groups, and to ultimately set the table for a tough vote, either in 2011 or late this year. Although I think there's clear controversy having a lame duck Congress address an issue as difficult as this. In summary, we are a great nation, arguably the greatest in the history of mankind. But Greece was the cradle of democracy. Greece was a great, great civilization. Greece was once great too. And we need to learn from history. Not just Greece, which is in the news today, but think about the Roman Empire. It fell for a number of reasons. Decline in moral values and political civility at home. Overconfident and overextended militarily around the world, and fiscal irresponsibility by the central government. If those sound familiar, it's time to wake up and start putting processes in place to make tough choices before we pass a tipping point. We must learn the lessons from history and act before a crisis is at our doorstep. And to begin, I look forward to what President Obama has to say about this commission, and I'm hopeful that political parties won't play politics with it, and I think if they do, they just might be punished at the polls. Because in my view, what happened in Massachusetts was not a victory for Republicans. It was a rise of independence. It was disgust with the status quo. It was a desire for real action, and it was a calling for Washington to become more connected with America. I know we can. I know we must. I hope that we will make tough choices sooner rather than later. And if we do, our future can be better than our past. And if we do, the American dream will stay alive. And to me, that's the only option that we should be pursuing. Thank you very much.
Hi, David. John Ward from the Daily Caller. I had two quick questions. One, the panel before you were pretty unanimous in their opinion that the American people don't get it. You seem to have a different opinion, and I just wanted to know if you could comment on that. Second, you're very strongly supporting a fiscal commission. The president has talked about creating one by executive order. Do you support that sort of a commission, or do you think that Congress should go back and try to pass one again that would have more teeth?
Well, first, I have great respect for all the panelists that were here before, but frankly, I've been to 46 states doing town hall meetings And so I think I'm a little bit closer to where the American people are. Secondly, we have commissioned, meaning the foundation, a number of statistically valid public opinion surveys with Peter Hart and Public Opinion Strategies. The results that I gave of the 80, 66, 70 percentile responses were as of the end of November, and if anything, I would bet money that they've gone up since then. Now, what the American people aren't as much together on is how do you solve the problem. They know we have a problem. They know it needs to be solved. They understand it's prudent to do it sooner rather than later, but exactly how you do it, how you reform Social Security, how you reform the healthcare system, what do we need to do on the tax side, etc. That's where this commission has a very important role to play and start talking about solutions. And quite frankly, that's what my book, Come Back America, talks about. It talks about solutions, policy, operational, and political reforms, and we need all three in order to help put us in the right stead going forward. On the commission, I think a statutory committee is clearly preferable. It's preferable so that you get buy-in from the Congress and the President up front. It's also preferable from the standpoint that's the only way you can have a guaranteed vote. So I strongly favor a statutory commission, but in the absence of being able to get a statutory commission, a presidential one will do. Doing nothing is not an option. At least it's not a prudent option.
Last question.
So I'm Greg Schuckman from the University of Central Florida. Between 1970 and 2000, improvements in healthcare were estimated to be worth about $95 trillion to the U.S. economy. And over that same period of time, the National Institutes of Health received about $200 billion in funding. So you can look at in terms of return on investment. And I was curious to get your thoughts about an investment-oriented budget, investing in those things that we might believe would lead to longer-term savings downstream, like medical research, like education, et cetera.
I believe that first we need to do a fiscal future commission to avoid passing a tipping point, which would be a loss of confidence by our foreign lenders in our ability to put our federal financial house in order. We need to make a down payment on that. So I think we have to do that first. The next thing that I advocate in the book is a rebaselining of the federal government. Most of the federal government is based upon conditions that existed decades ago that may or may not exist today. Priorities that were determined decades ago. We need to relook at our spending programs and our tax policies to make sure that they are future-focused and to make sure that they are results-oriented. If you do that, you will find that you will end up eliminating a number of things, consolidating a number of things, cutting back on a number of things, and free up resources to better be able to target the things that can help grow the pie, help improve our competitive posture, but we can't layer on top. That's what government has done for too long. They've assumed that the base is okay, and they've added on new spending programs, new guarantee programs, new tax preferences on top, when in fact the base was unsustainable. So we've got to look for those opportunities, but to afford them and fund them and sustain them, we have to engage in the fundamental restructuring. Thank you very much.
Thank you very much. What I'd like to do is ask the next panel to come up and join us here as we switch over. A quick housekeeping note while the new panelists are coming up. We have an overflow room, as you probably noticed, and we have brilliant budget economists, journalists, and luminaries who are standing. So if you have a coat or a bag on a chair, would you mind removing it so we can make sure everybody can get a seat, please? Okay. I'm really interested to see where this panel is going to go, because I think this is one of the most fascinating topics of all this, sort of the economic, the financial, and the global component of this fiscal path that we are on. And we have today an all-star panel joining us to discuss the issues. First, right here on my left, we are joined by Dr. Martin Baily. He's a senior fellow at the Brookings Institution, and he was the chairman of the Council of Economic Advisors during the Clinton administration. Richard Berner, as the Managing Director and the co-head of Global Economics and Chief U.S. Economist at Morgan Stanley. He's written widely on the potential effects of fiscal issues and situations that could affect the financial markets, the fiscal situations, how they could affect the financial markets. Carlo Cottarelli is the Director of Fiscal Affairs at the IMF. And I direct you to the papers that the IMF is putting out on this topic. Many years ago, I switched fields because I discovered CBO papers and how fascinating they were, and they're what got me fascinated in the budget. Recently, the same thing I found is happening with the papers coming out of the IMF, and Carlo's name is regularly on them. So I really direct you to the work that they are doing. I have given them a very wide range of topics to discuss because I think one of the most fascinating things is so often we talk about we are on an unsustainable path, we risk a fiscal crisis, but very little is really understood about what that means, what that looks like, how that might play out, what could be a tipping point for financial markets. I don't expect that our panelists could possibly answer those questions, but I hope that they will address them because as we're moving on to in the policy field, the time where we need to start talking about specifics, we're moving on to the economic and financial field, the time where we really need to be learning quickly from what's going on around the world and have a finer sense of how markets are watching and responding to this situation. So please, Dr. Baily, if we could start with you.
And I assume we do this in 5 minutes each.
Yeah, there you go.
Or less. The title of this session, if you read it one way, is What Are Markets Thinking? Lessons from Overseas. And that sort of sounds like a book that might come out of the Brookings Institution or AEI. You could read that title a little differently. You could sort of say, what are markets thinking? This is kind of an odd situation we're in because 10-year treasuries last time I checked were yielding about 3.6%, which is pretty darn low, and suggests that, and indeed as a result of the Greek crisis, although that's dissipating now, both the dollar went up and treasury interest rates went down as there was a flight to safety. Now, when you listen to the panelists and to David Walker, it's very funny to think that that U.S. treasuries are a flight to safety place that you would go. Since we're looking at these enormous deficits, we have a relatively broken political framework. So it's an odd paradox that interest rates are so low. Why is it, and what does it indicate about this tipping point that we've heard so much about? I think it's probably because however bad the situation looks in the U.S., it probably looks better in some respects than many of the overseas economies. China, of course, is a different story, but China's not a place where you would necessarily go to buy their debt. They're a capital market that's more restricted. So I think markets are expecting a recovery in the U.S., an economic recovery that's probably going to be stronger than in Europe. I think there may also be greater room to resolve the problem in the U.S. We start with lower tax rates than Europe has. We could have the potential to institute a value-added tax or a gas tax or something like that. So I think markets, global markets, are reflecting that they're a little bit more optimistic than the message you would have gotten from the speakers this morning. Now, does that mean there isn't a tipping point and the speakers were wrong? No, I think they were right. I think there is a tipping point. I don't know where it is. I know that Treasury and Tim Geithner are very concerned about it. I don't think they know where it is either, whether it comes with a debt to GDP or a deficit level, or the fact that the U.S. is so big, which cuts in two directions. When we have a deficit or we're financing our deficit overseas, we're talking about huge amounts of money. 85% of the available capital in the global market in the years prior to this financial crisis came to the United States. So we really are, as Bob Reichow said, we really are sucking up the global supply of savings that comes into the global capital market. So I think this tipping point is there. It would show up as higher interest rates and potentially as a lower dollar, and the dollar had declined somewhat before the Greek crisis. Now, part of the mandate for this session is lessons from overseas. I think one lesson from the European crisis that I hope we learn, and I hope Congress learns, is that the tipping point really is out there. That if you go too far, and Greece clearly went too far, then the value of your debt starts to depreciate. And as various people have said, there's somebody out there that may bail out Greece, although I don't think Greece will have such an easy time with this situation. But I hope Congress learns the lesson from what's happening in Europe to say that let's not push the envelope on this one. Now, various of my colleagues have said to me, you know, Congress is not going to get serious about the deficit until they actually see interest rates rise. So I think if that's true, what we've got to hope is that interest rates rise slowly, that we don't hit a tipping point and literally drop off the edge, and that Congress does indeed react to rising interest rates or a declining dollar by reining in the fiscal deficit. There was comments earlier that we're in the hands of our creditors, and there's obviously some truth in that. However, they are in our hands too. I mean, you know the old axiom, if you borrow $1 from the bank, they own you. If you borrow $1 million, you own them. And I think there is some truth in that with respect to China. If they start unloading our debt or not taking on more of our debt, then it will affect their own exchange rate and their own ability to export, and they're probably more scared of that than they are of default on U.S. Treasuries. So they'll complain a lot about U.S. Treasuries, but I suspect they will continue to hold and keep buying those in the future. And I think that's another reason markets are sustaining reasonably low interest rates in the U.S. There's nobody really, the Europeans, the Japanese, the Chinese, others in Asia, there's nobody really wants to see a collapse of the dollar and a lack of access to the U.S. market, which is still so important to the global economy. Quickly, I'm going too slowly. There was a question about can we grow our way out of the problem? And in the earlier panel, John Podesta mentioned a number of things that had been done that gave rise to the budget deficits when he and I were in the Clinton administration, and he's absolutely right. There were some very hard choices that were made around policy. But we were also helped very substantially by the rapid growth of the economy, that we had an increase in the rate of productivity growth. We had very strong employment. Now, some of those things may have been helped by the policies that were followed, but we were also somewhat lucky in getting that rate of growth. Are we going to have that in the future? Is that going to bail us out? Well, maybe. It certainly is not in most forecasts. I made a prediction that labor productivity in non-farm business would grow at about 2.2% a year. And I was talking to a reporter from The Economist, and he said, wow, that's a high number. Well, we had 2.5 in the 1990s when we balanced the budget. So 2.2 is not a particularly rapid rate. We also know that hopefully employment will increase in the recovery as we get back to full employment. But the rate of growth of the labor force is not going to be all that strong because of the demographics that is affecting the entitlement programs, but is also going to affect the rate of growth of the labor force. I think there are some things that can be done to increase the rate of potential growth around technology, education. Those things have been mentioned, about encouraging entrepreneurship, about having more gazelles in our economy, companies that start small and grow rapidly and employ a lot of people. But those are tough policies to do, and it's tough to get a big bump out of them. So while I certainly hope for that kind of rapid growth, I don't think we can count on it. And my last quick comment is going to go back to some of the earlier points about the nature of the debate. And I want to say that I think we do not have an effective debate either about the budget or about Medicare and Medicaid, which are such crucial components of that Medicare. And I want to mention a couple of things. A U.S. senator was holding town hall meetings around the time of the healthcare debate and the public option, and he was being yelled at by everybody in the room. Some were sort of Tea Party folks, some were on the left, and they were all yelling at him. And at one point he said, now you guys do know that Medicare is a public option, it's a government program. whereupon half the people in the room started calling him a liar and saying, no, it's not. So I don't think, you know, I have great faith in the American people and all that stuff, but I don't think we have at the moment a very well-informed debate. I would also mention Paul Krugman, and he wrote an article in the New York Times last week that said, you know, this roadmap for the future is really a Trojan horse to dismantle Medicare. Well, maybe, but I don't think you can get reelected in the United States if you're going to dismantle Medicare. So I actually don't think that's right. I think it's actually worth thinking about whether we want to create a budget for Medicare. And, you know, what form would that take if we actually put some limits on the spending for Medicare, and what would that mean? And then, you know, you'd have sort of Sarah Palin, another of my favorites in public debate, and she says no death panels. Okay, no death panels, so we're going to spend $500,000 to keep somebody 90-year-old alive who doesn't know where he is or what's going on. Okay, maybe that's right. Maybe that's the moral thing to do. But on the other hand, that means we need to raise Medicare taxes from 2.9 to 3.9 to 4.9 to 5.9 or whatever it's going to be in order to balance Medicare. So I don't think anybody is creating the right debate around health care and other budget items. And until we get the right debate, I don't think anybody is going to vote for the politicians that are going to make the decisions that need to be made. And so that, as earlier panelists said, is a big part of the solution. Thank you.
Great point. It's really interesting. Thank you. Dick?
Thanks, Maya. So my homework was to try to assess what markets are thinking, and I thought I'd start by asking the question, what do markets want? And I think, like everybody in this room, market participants, both at home and abroad, would like to see a credible plan to get back to fiscal sustainability. By definition, credible means a lot of the things that Bob Reichauer talked about, including one that does not kill the economy. So what are the thoughts of investors at this stage of the game? And to answer Martin's question, why haven't we seen some of the concerns about the budget showing up in various asset prices and in interest rates? Well, I think investors are in between some of the tail risks that are out there for the budget. They recognize the tail risks, but they don't think they're clear and present dangers. They understand that we have a little time to do something about our budget. Not as much as before, but it's not a clear and present danger that requires immediate austerity, unlike in some other parts of the world. By the same token, they are alarmed by the prospects of looking at deficits as far as the eye can see, a phrase that we heard some 20 years ago or more in earlier budget debates. They do know that there is no credible plan yet to really grapple with the budget problem. And so what do they fear, and how are they likely to make that play out in financial markets in the future? To answer that question, I think I'd talk about 4 fears that investors have that line up with some of the components to interest rates that we observe in financial markets. 4 components are inflation, the factors that drive real interest rates, and 2 kinds of risk, currency risk and just the risk associated with the uncertainty that is bad news for financial markets. In a nutshell, I think that there are a lot of investors out there who believe that today and in the future, ultimately, sovereign credit risk, whether it shows up in Greece or the United States, will be inflation risk. The temptation to erode the value of the deficit and the debt and the legacy problems that we've inherited is obviously strong in some abstract sense. And there are some economists who have proposed that we actually raise an inflation target temporarily in order to facilitate that process. Unfortunately, I think in the United States at least, we have 3 problems with doing that. First, if we were to announce a higher inflation target, that would show up immediately in nominal interest rates and would be counterproductive. Second, if I'm not incorrect, if I look at the budget that we have in the United States on the outlay side, roughly half of our outlays are either officially or unofficially linked to inflation. And you could argue that Medicare, although not officially linked to inflation, with excess cost growth, would respond to inflation overall with even more of the same. And third, the Federal Reserve, it seems to me, would still, and I say still because many perceive that the Fed is up against the wall politically, would still respond appropriately and strongly. And I know we're going to hear from our lunchtime speaker on that score. The second risk, I think, relates to the factors that drive real interest rates. Obviously, as everybody here has indicated, from David Walker to Martin Baily, that real interest rates are comparatively low, certainly by comparison to some other economies and markets around the world. And I think part of the reason for that is that while we have massive Treasury borrowing needs, the economy cyclically is in a point where private credit demands are still very weak. As the economy recovers and private credit demand recovers as well with a lag, it seems to me that there is a very real risk that real interest rates could rise very significantly. And that's a factor that I think is not right in the price today, but it seems to me that it's going to be there in the future, ironically with a recovering economy. The third risk is one that others have talked about, namely currency risk. There is diversification going on away from our debt. Global investors and sovereign wealth funds and reserve portfolio managers don't need to sell treasuries in order for that to happen. They simply need to buy less of them. And all the investors around the world whom I talk to are contemplating buying fewer treasuries. Maybe they won't buy fewer dollars, but if they buy dollar-denominated investments, they're likely to buy strategic investments, or they're likely to buy other things besides treasuries. And I think that that's certainly a risk out there. The last risk is one that we typically talk about as a risk premium or a term premium in bond markets. And that arises from pure uncertainty in markets. Typically, we think in markets we know how to quantify risk, but we don't know how to quantify uncertainty. And the biggest risk right now, it seems to me, is a political risk. The political risk is something we can't quantify, but in financial markets, people have typically talked about gridlock being good for financial markets because it keeps politicians off the streets, it keeps them from interfering with markets, and so that's generally perceived in the past to have been good. Right now, I don't think that's the case any longer. I think that we've got problems that demand political choices and political solutions. Gridlock is now, it's now dawning on investors that that's bad for financial markets, and I think you're going to start to see that play out in our markets as it is in others as well. I'll leave it there, and we'll take questions.
Maya, thank you very much. I was asked to give a bit the international perspective, and I will say a few things about some basic facts, the risks, and the possible solutions. Basic facts, the fiscal problem that the United States is facing is common to most advanced countries, not all, but most other advanced countries. The emerging markets are in a better situation, particularly Latin America, Asia, they're in a much better fiscal situation, a bit weaker in Europe. But the big picture is that this is a problem that is mostly affecting the advanced countries. We project that between 2007 and 2014, the public debt to GDP ratio in advanced countries, in the G20 advanced countries, will increase by 40 percentage points, from about 80 to 120% of GDP. Second point, only a relatively small part of this 40 percentage point increase, only about 6 percentage points, is related to discretionary actions taken by governments in support of the economy, the so-called fiscal stimulus, or in support of the banking sector. Most of it comes from revenue losses related to the recession, lower payments from consumers, from households, lower payments from enterprises, lower payments from banks. It comes from an underlying increase in spending in some countries, like security spending in the United States and health spending in Japan. And it also comes from the increased burden of interest payments. Third point, even if we assume that the fiscal stimulus, the discretionary fiscal stimulus is not renewed over the next couple of years, and even if you assume some other reduction in temporary spending, the United States, as well as the advanced countries, will still be running a structural primary deficit in 2014. What does it mean? Structural means that netting out of cyclical factors when the economy is back to where it should be. Even at that point, the advanced country will still be running a primary deficit, a deficit net of interest payments. So revenues, net of other spending, will not be enough to pay for interest payments on the debt. This in 2014, at a time when, as I said, the output gap will be closed. We don't expect to see, we see unemployment going back to normal. Can happen before, but by 2014 that should be the case. At a time also when the demographic shock will start hitting most advanced countries in full swing, and at a time when the public debt will have risen to a level that has not been seen since essentially the aftermath of the Second World War. Even now, if you take the G7 advanced countries, in 2010, the level of public debt is back to where it was in 1950, in the aftermath of the Second World War. These are the facts. What are the risks? There are short-term risks of the kind that you see, kinds of development that you see now in Europe, a sort of loss of confidence in public finances. But there is another medium-term risk, namely that, well, everybody agrees that public debt cannot increase forever, but the question is that if governments could decide to stabilize public debt in relation to GDP at the post-crisis level, which would be about 110, 120% of GDP, depending on the countries. What would be the consequences of living with a public debt to GDP ratio of this level? There will be consequences for interest rates. We estimate that as a result, living with public debt at this level will involve an increase in interest rate on public debt of about 175, 180, 200 basis points, 2 percentage points of GDP, roughly speaking. There may be consequences for growth. Our most recent econometric work will show that living with a public debt to GDP ratio about 40 percentage points higher could reduce potential growth by about 0.75% of GDP, 0.7, 0.8% of GDP. So every year, as long as you keep public debt at this level, growth will be lower by about 0.7, 0.8 of GDP. So these are important facts to keep, important risks to keep in mind. What are the solutions? I don't think that inflation is a solution. As was just mentioned, some economists have argued that inflation should be brought up to, say, 6 percentage points for 5 years. We have computed what would be the effect on public debt of raising inflation to 6% for 5 years. Yes, there will be a lower public debt to GDP ratio, but the erosion coming from inflation of public debt will be only about 7-8 percentage points of GDP for the advanced countries, against a trend increase of 40 percentage points of GDP. So less than 1/4 could be eroded by inflation, unless you want to bring inflation to a very high level all of a sudden, which nobody really wants. Growth must be part of the solution. Growth has huge effects on the fiscal accounts. For a country like that has the tax to GDP ratio of 40 percentage points of GDP, like in Europe, a 1 percentage point increase in growth, if you save the additional revenues that you receive as a result of growth, would lower public debt by 30 percentage points after 10 years. It's a huge effect. So growth must be part of the solution. But I think it would be very inappropriate, not really cautious, to base fiscal adjustment plans on the assumption of strong growth. One lessons from abroad. I've seen too many fiscal adjustment plans based on optimistic growth assumptions. Growth assumption must be cautious because you don't know. Even if you reform the goods market, the labor market, you don't know when the returns of this is coming. So you must make a prudent assumption on growth. And then if growth is higher than projected, you should benefit from the windfall. But you will not have a credible fiscal plan if you assume that growth will be 7-8% for the next 10 years. So what I'm afraid what is needed is a tough decision on revenue and spending. First, the adjustment is large. The needed adjustment is large. As I said, if the debt to GDP ratio of advanced countries is projected to go up by 40 percentage points, if you want to bring it back to about 60%, in the next 2 decades, the primary structural balance of advanced countries has to improve by about 8 percentage points of GDP. It's a very large number, 8 percentage points. It's very large, but it's not unprecedented. In the last 2 decades, we have seen 12 advanced countries who managed to adjust their primary balance, structural primary balance, by 8 percentage points of GDP or more, and 22 emerging market countries that managed to do so. It's not impossible. It's going to be very hard, but not impossible. What makes it harder is that advanced countries will have to sort of swim against the tide, because not only that we have to swim far, reduce the deficit by quite a lot, but they will also have to do this when there is a trend increase in spending for health and pensions relating to the aging of the population. We compute that for the advanced countries, the trend increase in health spending, healthcare spending, and pension spending over the next 20 years is about 4 to 5 percentage points of GDP, with figures that are a bit higher in the US, but are also very high in Europe. These reforms are critical in this area, but they will not be enough because of the aging of the population. What can be expected is to keep spending in these areas constant in relation to GDP. So that means that the 8 percentage point of GDP I was referring to before will have to come from other sources. The last point I want to make is that this will be a lengthy process. One cannot expect to bring back the debt to GDP ratio to where it was in just a matter of 2, 3, or even 4 years. It is going to take time. And because it's going to take time, it is critical to maintain the course of fiscal policy for a long time. And this may require, in some countries, or maybe in most advanced countries, reforms in fiscal institutions. Germany, for example, has recently introduced a constitutional amendment implying that the budget will have to be balanced within the next 4 or 5 years, net of the effect of recession. So unless there is a recession, the balance should be, the fiscal account should be balanced. I'm not saying that this is the only solution, but I believe that most advanced countries should strengthen their fiscal institutions. It has been mentioned in the earlier panel, for example, the fact that in the United States there is a need for a strategy, for a better strategy for medium-term plans. And I think this is true for the United States, and this is true for most advanced countries. Thank you.
Great, thank you very much. You bring up such an important point, I think, about where we end up stabilizing the debt, because I feel like in the first panel and in other discussions that have been going on in the past months, there really has been a consensus about the need for the fiscal goal, and that fiscal goal should be stabilizing the debt at a reasonable level over a reasonable amount of time. I do, however, think that there will be pushback at some point, again, when people start going through this exercise of what it actually takes to maybe up that level where we decide to stabilize the debt. And one of the big risks there, of course, is that you slow economic growth, and also that you have a real loss of fiscal flexibility. The kind of advantages that we and other countries had going into this crisis is that we had relatively low levels of debt and were able to ramp it up to respond. But if you don't bring it back down to pre-crisis levels, you don't have that flexibility going forward. One question I have for the panel, I think when we talk about monetary policy, or regularly when we talk about monetary policy, you talk about the exit strategy. And I think that's also critical for fiscal policy. In the Peterson-Pew Commission, we did talk about weighing the trade-offs between implementing fiscal consolidation too early, where it could destabilize the recovery. But there's another component, which is the global factor. You have countries around the world who are facing the same situations where they have fiscal stimulus and will need to pull out of the stimulus at some point. To what extent does that need to be coordinated, and to what extent are countries working on coordinating that?
Yeah, I mean, the fact that many countries will have to implement fiscal adjustment at the same time over the next years complicates things, obviously, from a demand, for the world demand management perspective. I think that the main coordination that is needed relates to the coordination between monetary policy and fiscal policy. As I would expect that if fiscal adjustment takes place, we will see increases, we will see less of a need for raising interest rates in the next few years, because essentially interest rate could be kept a bit lower if fiscal policy withdraw stimulus, so as to be able to crowd in the private sector as the public sector crowds itself out. It's going to be more difficult to have a coordination of fiscal policy in terms of the main fiscal aggregates across countries, because each country will withdraw based on its own domestic needs, and not all countries are facing the same needs at the moment. In some countries, the recovery will come earlier than in other countries. The fiscal problems also are not the same across countries. What I think, where I think more coordination will be possible will be in some critical fiscal actions, for example. Tax policy is something that I think is going to be hard because of essentially tax competition for countries to take tax measures in a global economy without discussing them with other countries. So that, I think, is an area where more cooperation will be needed in the future.
The comment I would make on that is that in the period leading up to the crisis, we had these very large global imbalances with the U.S., a huge and growing trade and current account deficit, and the rest of the world, notably China, but some other countries having very large surpluses. And I think it's widely thought that those global imbalances was one of the contributory factors to the crisis. I don't think it was the only one, but it certainly was an issue. As we get back to dealing with the budget deficit problem, I think there is a sense in which the rest of the world has the responsibility to make sure that we don't get into a global recession. The U.S. needs to have a forward growth path which is more export-oriented, a little less consumption-oriented. We've sort of done that in this recession because consumption has dropped so much. We need to go forward on a more sustainable balanced growth path, relying less on foreign borrowing. But the other side of that coin is that the adjustment of the rest of the world has to be to maybe import a little more or sustain their demand domestically to make up for the shortfall of what the U.S. was providing to the world economy. So that's, I think, the key coordination that's needed.
I just add a worry and a hope. The worry is that in this environment, one of the policies that might be perceived on a local basis to be helpful is protectionism. And clearly that's not going to be helpful at all. But to protect local jobs and old jobs as opposed to creating new ones, I think that's a risk in this environment. The hope is that as we see other countries, as Carlo mentioned, who are outperforming because of structural changes and transformations that they're making in their economies, some of which you can attribute to changes in fiscal policy. And I'd point out that in some Latin American countries, notably Brazil, and in others, those have borne fruit. That the outperformance there over time will contribute to an example so that others can follow. along with that, and that those lessons are lessons that we can learn in the developed world.
We have time for a few questions. Yes, right there.
Thank you, Maya. You guys, the commission always puts together pretty good, very good panel and forum. I'm Thierry Dangala with Americans for Generational Equity. I just have a question on two topics, inflation and the savings rate. If you could comment on these two. Inflation in the context of, how would you say the market is interpreting? I mean, I reluctantly agree with the IMF, in saying that, inflation is not the preferred way of going, but wouldn't you say that the market's interpretation is that the only way that we're kind of, going out of this debt problem is to inflate our way out of this? A good example is the, TIPS, the popularity of Treasury inflation protected security sales. It seems like the market's kind of like edging on the side that we might let inflation kind of inflate our way out of it. And in that regards, and I would also kind of like put it in the context of Greece.
Well, yeah, just wind up. Yep.
Yeah, well, with Greece's savings rate was pretty low, and and like we look at Japan, their debt to GDP ratio is high, but a lot of their savings rate is much higher than the U.S. So doesn't that have a lot to do also with how volatile our debt to GDP ratio would determine the fluctuations in the market?
Maya slipped out. Obviously, she's bored with this discussion, but she made some other excuse. But anyway, Dick, do you want to respond on that?
Sure.
Inflation?
On inflation, you do see a rise in break-evens in the financial markets. But I think that the real key to thinking about how investors are positioning themselves for inflation is to look at things that are not so evident in the TIPS market. People are buying options on inflation. They're in the minority right now. They're obviously powerful disinflationary forces, and a lot of people are looking at the credit problems around the world as being destructive of growth and therefore being disinflationary. And there's a lot of truth to that. The question is, what's the policy response? And the policy response really is, if you're going to bet on much higher inflation, then you're betting on taking away the power of central banks to be independent and to keep inflation and price stability as it has been a primary goal for central banks in the past. And some people are starting to bet on that, but we don't yet see it in markets. On the saving rate, I think what Martin said earlier is really important. Namely, we have benefited from a flow of saving from abroad, no question, to finance our deficits. And we are boosting our domestic saving, which helps rebalance the U.S. and the global economies. But the problem is that the fiscal problems we face are so massive that no amount of increase in private saving is likely to help finance that deficit. On the contrary, it seems to me that if we were to save a lot, we would run into the paradox of thrift, in which that jeopardized our economy. And second, if anything, I think as we start to see our economy come back and credit demand starts to come back, we're really going to see the effects of the clash between public and private borrowing show up in our financial markets with higher real rates.
Well, one of the things that I worked on with the McKinsey Global Institute was a look at different adjustment paths, and we were struck by how short-term the U.S. Treasury market is at this point. It's really predominantly under 2 years maturity, so inflating your way out of the debt problem is not, I think, a great solution for Treasuries. Now, it would probably change the mortgage market and some of the private debt if you had an abrupt increase in inflation. But I think the temptation to do it to get out of the government debt is not very strong. Well, I'll cede back to you the chairmanship. So go ahead.
1 minute break. Yes, question.
I had two questions. Mr. Cottarelli, Oliver Blanchard, the chief economist of the IMF, produced a report last week suggesting that central banks should raise their inflation target from around 2% to the 4 to 6% range. Is this now the official policy of the IMF, endorsing higher inflation as a solution to our fiscal problems? And Dick Berner, right now, as you said very correctly, we don't have any pressure on bond yields because credit demand in both the household and private sector is declining. We've had a big reduction in bank loans in the last 6 months and so on. Let's look out to 2012. Assume there's no progress on this fiscal problem we're talking about here today, and we're still looking at budget deficits 1.2, 1.3 trillion. How high could bond yields go in the election year 2012 if we don't make any progress on the budget deficit? 6%, 7%, something that might then frighten Congress into taking action.
Okay, thank you. Maybe I should ask my friend Olivier Bachar to come here next time with me. The views that he has expressed are his personal views that have been issued as part of the publication that contained this paper is a staff position note that presents views of individuals, not views of the IMF. But here I would like to say that he was looking at this from a specific point of view, namely how to manage aggregate demand in case of a recession when interest rates cannot become negative, nominal interest rates. So from that, he was just looking from this specific perspective. From a broader perspective, the issue that I was referring to is the fact that inflation not only is not the right thing to do, but it's not really very effective in reducing public debt. As I said, unless you want to push inflation to very high level in a very short time, which really nobody wants to do because it would be very costly to bring it down. It would harm the poor. Nobody is really thinking about that solution. On the question of the bond yields, in a way, I have already expressed my views on this. I believe that keeping public debt at a high level would have consequences would have implications for interest rate the government is paying. The basic number that we have is that 1 percentage point of additional debt implies an increase in interest rates of 5 basis points. So a 40 percentage point increase in public debt would involve about a 200 basis points increase in interest rates. All other conditions being the same. Then if the private sector starts saving more, as mentioned, obviously the effect could be lower. But in itself, a public debt increase of 40 percentage points of GDP would involve, in our view, something like 200 basis points of higher interest rates.
David, I agree with Carlo's econometrics, and I'm a card-carrying member of Maya's announcement club, which means that I think part of the critical issue here is to come up with a truly credible plan to do something about our fiscal problem. Lacking that, however, and I'm skeptical that we will in the short run, lacking that, I think when private credit demands come back, we could see 10-year Treasury yields go to 5.5% in fairly short order. In fact, that's our view. And I think that that doesn't necessarily mean that we'll kill the economy, but it does mean that higher rates are going to make it even more difficult to reduce the deficit because debt and interest rate dynamics are going to push up that deficit and in the debt ever more quickly.
And just in case people don't know, or people in the C-SPAN audience don't know, the Announcement Club is something we copied Greg Mankiw's Pigouvian Club, where he tracks people who support energy taxes. We now have a long list of impressive budget people who support the notion that you need to credibly commit to a budget plan now and then phase it in later, thereby buying you some time and some economic space to let the recovery take hold. So I'm so glad that we have wonderful members like Dick Berner. We have time for one more question, then we'll move on to the next panel.
My name is Phil Carrata, and I'm a writer on economic issues for the State Department's Public Diplomacy Bureau. And the Obama administration has proposed taking the proceeds of recovered funds from TARP and funneling it into the Recovery Act and further stimulus. How do you think the markets would react to this policy? Primarily you, Mr. Berner, but Mr. Baily and Mr. Cottarelli also, if you'd respond. Thank you.
Well, just from a budget perspective, the administration had, if you will, announced and put a placeholder in its budget for last year that was very large for future TARP spending, which didn't occur. Since the spending didn't occur, taking that allocation and moving into new spending, which might occur, I think markets see through that and look at that as a net increase in public spending. You know, the political judgment near term as to whether that's needed for stimulus, I think is one thing, but nonetheless, I think markets will correctly look at that as increased spending. And at this stage of the game, I stick to what I said before, namely, if we are now in a process of working towards bad gridlock and there is no credible plan to reduce the deficit, my expectation is that's going to show up in financial markets that much more quickly.
I don't want to comment about how the markets will react, because you're in a better position to answer that. But the point I want to make is that the difficulty of the current situation that the US and other countries are facing is that there is still, the economy is still very weak. It's clear that it's still very weak. That's why the IMF says that for 2010 it will be necessary to continue to support economic activity through fiscal policy. On the other hand, nobody wants to have a loss of confidence in the fiscal account. So what is necessary to reconcile these two needs, in my view, is to implement important fiscal reforms that do not have an immediate negative impact on aggregate demand, but have long-lasting effects on the fiscal accounts. An entitlement reform, an increase, for example, in the retirement age in Europe, it has been computed that a two-year increase in the retirement age in Europe could save as much as 40 percentage points of GDP in net present value of public debt. Reforms of this kind can be implemented now, even in a recession, and do not have negative consequent impacts on aggregate demand. This is the kind of measure that are needed. The other kind of measure that can be implemented now are the institutional reforms to strengthen fiscal institutions. Things that have an impact over the medium term but do not have a negative impact on aggregate demand now.
Let me just add one more thing which hasn't been brought up on this panel and only alluded to on others, and that is our fiscal federalism. You know, everyone's starting to become aware that we have a huge state and local budget problem. I'm not sure that most people are aware that we could have a hole in just state and local pensions alone that could be as high as $2 or more trillion. That's on a present value basis. That funding gap, unless we break the promises to future retirees, is something we're going to have to deal with, either by breaking those promises or raising revenue somehow to pay for it. But it's even worse than that, and this speaks to Carlo's call for fiscal reform. And that is, when we think about fiscal reform, we have to think about the structure of fiscal federalism when it comes to Medicaid, which is essentially a put by the states back to the federal government and to the taxpayer at large, so that Medicaid is a program that's shared by both state and local, state and federal governments. But when we get into a financial crisis like the one we've had, or even a mild recession, Medicaid eligibility goes up dramatically, and the means to pay for it at the state level goes down dramatically. So when you think about that from a cyclical perspective, and the need to fill that hole, and the burden that places on the federal budget, which can be long-lasting, that's one aspect of it. But the other aspect of it is that these promises that were made at the state and local level, not just for pensions but also for health care, are likely to, in a poor fiscal environment for the states, likely to come back to the federal level. You know, we're seeing the dynamic, the political dynamic of that playing out in the sovereign debt crisis in Europe. And it's likely that we're going to see the same dynamic play out in the United States. The solution, of course, is to reform our fiscal institutions, and that includes fiscal federalism.
Yeah, I think that's an important note to end on. One of the problems we have in dealing with these huge challenges is how compartmentalized our policy making is in so many ways, and that's true in both policy areas, but it's also true with the levels of government. And I remember, Dick, meeting with you years ago, and you warned me saying the state and local pension thing is going to explode. And Unfortunately, it seems that the timing of this is these implosions are all going to take place at once. So, Carlo, Dick, Martin, thank you so much. It was a really constructive and informative panel, and I hope, and I'm sure we'll hear.
I hope we don't slit our wrists here.
Yeah. Well, now we're turning to politics.
Economic growth will help.
That's right. There's the free lunch, economic growth, if only. And now we'll turn to the really, really depressing topic of politics, where it all breaks down. So, thank you so much.